and welcome to the Of Interest podcast. I'm Gareth Vaughan from interest.co.nz. Finance Minister Nicola Willis last week announced a Parliamentary Select Committee inquiry into banking competition, something promised in the National New Zealand First Coalition Agreement. Of course, this comes with the Commerce Commission already in the middle of a market study into competition in personal banking services. The Select Committee inquiry will, however, also look at the state of competition in the business and rural banking markets. Speaking in an episode of this Of Interest podcast in February, Commerce and Consumer Affairs Minister Andrew Bailey said the Select Committee inquiry could look at how to encourage banks to lend more to what he described as productive sectors of the economy, like small businesses, farming and property development, rather than them having such a big focus on unproductive housing lending. To discuss why New Zealand banks have such a big chunk of their lending exposure in housing and what could entice them to lend more to businesses and the rural sector, I'm joined by Cameron Bagrie of Bagrie Economics. Hi Cameron, and welcome to the Of Interest podcast.
Good morning.
Great to have you with us. I guess a good point to start would be to ask you, is it a problem for New Zealand Inc. that bank lending is so heavily weighted in favour of housing lending? And if so, why?
Yeah, if you have a look at the OECD Economic Survey of Australia way back in 2021, they had an entire chapter on the financial sector and they discussed small to medium-sized enterprise access to credit. And one of the pieces of research that they pointed to was that you get a lot more productivity bang for your buck when you're lending into the business sector as opposed to the housing market. And what we know in both New Zealand and Australia is that there's been increasing skew more towards the housing market, and that comes at the expense of business and farming. Okay, so we are lending more and more into the less productive assets. So lo and behold, we are seeing productivity growth across New Zealand's been on a trend decline for the past 10 years, and we can point to a lot of the usual suspects in regard to infrastructure, education, the OECD talked about. But we need to have a good old-fashioned debate here about financial system settings, because at the moment, we've got a model that's conditioned to selling more expensive houses to each other, and that's not how you get rich.
And, I mean, why is it that banks favour housing lending over business and rural lending?
Well, you have a look at the risk weights for a start. Housing is considered lower risk. Banks need to carry less capital. So they're economically incentivised by the regulatory framework to push more money into the housing market, and that comes at the expense of real productive lending. So if you have a look, way back in 2000, home lending was about 50% of total bank lending. It's now 63%. What we've seen in the past 5 years is that the ratio of home lending to GDP of total lending has gone from 57% or 58% to 63% in 5 years. And one of the big drivers of that has not just been the weighting framework, it's been the Reserve Bank has sought that banks need to hold more capital. And banks can now get capital relief by altering their portfolios and shifting more money into the low risk weighted asset, which has been the housing market. And banks have done that partly because of the Reserve Bank's actions in regard to getting them to hold more capital. So you're holding more capital. It's not a competitive issue, in my view. It's coming down. We need to have a look at this through the eyes of economic efficiency, economic growth, productivity, innovation. Because when you make banks a lot more safer, there's a price that you pay on the other side. And what I think we're now starting to realise more and more is that there's no free lunch.
So how does the extent to which housing dominates total lending by New Zealand's major banks compare to banks in comparable countries?
So if you look at in Australia, for instance, we're pretty similar. But if you look at across the OECD, I think that the IMF has got a publication that was out a couple of years ago, and I think the figure off the top of my head was that home lending across the OECD is about 35 to 40% of total lending. That's sort of the reverse proportion that we've got in New Zealand, where we've got 35% as business and farm lending. Around the rest of the globe on average, it's about a 65-35 split, or we're the other way, broadly 65-35.
Okay, so, I mean, you've already talked a little bit about this, but if we drill more into what could actually be done to encourage more lending into the business and rural sectors?
If we want to point the finger, you can't just point the finger at one group. Now, competition or the lack of it across the banking sector, I think, is one issue. The Commerce Commission has had a bit of a look at retail banking. I think retail banking is reasonably competitive. I think there's a lot less transparency, openness over business and farm banking. We don't get that same sort of transferability. And this is where open banking could help. But you can't just, there's the competitive landscape. There's the regulatory framework. There's the triple CFA legislation, which has just turned out to be an absolute disaster in regard to, the modern day banker at the moment is so bogged down in compliance. They don't have the time to get out there and actually look after the client.
Is that, in terms of the triple CFA, though, the Credit Contracts Act you're referring to, that's more on the personal consumer banking side, though, isn't it, rather than rural and business?
Yeah, but it's also had an impact on business lending, because a lot of business lending does implicitly get channeled via the house.
Yeah.
The thing about banks is that banks price for risk, but it's questionable how much risk they actually take, because they tend to take an awful lot of security. So banks make what's called alpha profits. The Commerce Commission identified that we've got some of the highest banks around the globe. Now, profitable banks around the globe. Now, you could justify that if we were seeing tremendous volatility within the earnings. What we see is a pretty strong returns, and we don't see an awful lot of volatility within the earnings. That stands out as a fundamental problem, because if you're pricing for risk, expect to take it on the other side. But the data doesn't show that.
So, you've talked a bit about, obviously, the capital settings and the risk weightings within that. Let's look at that in a bit more detail. So, obviously, this is based on the Basel framework established by the Basel Committee on Banking Supervision. This is sort of international standards. The Reserve Bank of New Zealand sort of imports that, and they make their own tweaks to it. But are we fundamentally looking to? Do you think we need to actually change how that's done, and perhaps become a bit of an outlier compared to some other developed countries?
Not necessarily become an outlier, but everybody is broadly operating within the same rulebook. But for some reason, New Zealand's got a far bigger concentration of housing loans at the expense of loans into the real productive sector. And I think you can point the finger beyond Basel. You can point the finger at what the Reserve Bank has done with getting banks to hold more capital, which has just encouraged them to take a real low risk approach to where they're lending the money. We need to look at regulatory settings more broadly. New Zealand got caught up in that inquiry into banking in Australia, and what was a consequence of that? The front line was no longer receiving bonuses. Now, that might be appropriate, because you don't want to be incentivising people to do a deal that might not be fit for purpose in some situations. But when you take out an economic incentive, lo and behold, you don't have an incentive to do anything. So bank staff, business bankers at the moment take a real low risk approach. That they look after their portfolio, their existing portfolio, as opposed to really get out there and want to add to their portfolio and take a bit of risk, because there's no upside for them for taking that risk. But we can't just point the finger at the regulator and point the finger at various pieces of legislation. I think New Zealand has still got a pretty big problem here in regard to what we call how bankable are New Zealand businesses. How good are they? And I guess if you want an illustration of that, just have a look at what's been going on across the New Zealand Stock Exchange listed companies over the past 6 months. And we know that times are tough. We've seen the GDP figures, and the number today was up a little bit, but the overall story is still economic weakness, so that's hitting profits. But what we're seeing is what's called a microeconomic overlay here. There's some individual specific factors that are undermining their profitability. So I've got another business called Chaperon, helping businesses with banks. And one of the reasons that I set up Chaperon was, look, I knew where we were going to be 2 years ago economically, but also it's just to highlight these issues. Now, I wanted to call Chaperon bankability, to highlight a bit of onus on businesses lift your game, because if you're a better bankable business, you'll be a better sellable business. The Reserve Bank wouldn't let me use bankability because it's got bank in its name. So it's a chaperone was born. So we can't just once again point the finger at the Reserve Bank or point the finger at regulators. You need to point the finger at business, and we also need to point the finger at banks, because banks are taking a very low risk approach to how they're managing those books. They're becoming very vanilla, and that might be appropriate. But if you're going to become very vanilla and increasingly safe in your lending portfolio, expect to give up a bit of the ROE on the other side. And the problem is they're still getting the strong ROE and they're taking a very low risk approach, and those two don't go together.
There's a couple of really good questions coming out of that. Firstly, how does a business become more bankable?
It's not just about your traditional accounting framework and being on top of your numbers and being a good performer. One of the things that we find time and time again is that businesses are just not good at managing risks. And if you think about what the banking system is, it's all about managing risk. So yes, they will look at your operating statement, your balance sheet, cash flow, and all this sort of stuff. You need reporting systems in place that manage those things. But the fundamental relationship between a business and a bank is about the management of risk. And firms need to lift their game, in my view, on a whole lot of levels in regard to how they report and how they manage risks.
In terms of the banks and their appetite for risk-taking or lack thereof, I mean, if we're looking specifically too here at the business and rural sectors, are they inherently more risky than housing lending from a bank's perspective? I mean, if you look at loan default rates and that type of thing, and the loan security of the house compared to what the security might be for a business, especially a smaller business, if it's not a house, which, as you've pointed out already, often in New Zealand it is. But is that part of the problem, that the business and rural lending is inherently more risky from a bank's perspective?
Well, your business and farm lending is more risky, right? But because it's more risky, cannot be misconstrued with the fact that it's really risky. So if we go back and have a look at bank profits going back 30 years, banks in New Zealand have never lost money in a 12-month period going back to 1992. And prior to that, we had the BNZ shenanigans, but 30 plus years where they have not lost money. And what we tend to see is that, and we're seeing it time and time again at the moment, is that your banks are naturally allocating provisions and expectations that they're going to see more financial stress in the next 12 to 24 months. So non-performing loans are moving up, but if you ever look at non-performing loans as a share of total loans, it's about 0.7% of loans are what's called non-performing, which is incredibly low. That number got up, double that after the GFC. So we're still in a bit of a sweet spot in regard to the stress that we're seeing. What we also see, you go back over time, is that your banks might take a provision, and then because they tend to have such highly securitized positions, they actually get pretty well their money back. So you dial back those provisions at the start of the cycle.
Another thing on this is, and I mean, you've got obviously past experience, chief economist at ANZ, so you've been in a bank. But we often talk about how New Zealand's major banks are foreign owned. The owners are sitting, the big four, the shareholders over in Australia. I mean, to what extent is this a factor in how the big banks operate in New Zealand?
Well, from my experience, there is a fair bit of Australian influence that's exerted. Yes, we know that the New Zealand banks have all got their New Zealand domicile boards, but when push comes to shove, if head office says jump, you jump. Now, it's also a misnomer to say that New Zealand banks are Australian owned. They're Australian influence, but if you look at the shareholders are international. I think the true composition of the shareholders is more likely dominated out of the United States, but the head office is based out of Australia, and there's a lot of commonality between New Zealand and Australia, to be fair, but there's a whole lot of differences between the two economies as well. So sometimes you can see a bit of tension between what head office says versus what could be best for the local branch, so to speak.
And I mean, obviously, in the business sector, the big four banks, so ANZ, ASB, BNZ, Westpac are dominant. And in the rural sector, we've got those four plus Rabobank, which is headquartered in the Netherlands. But from a competitive sense, I mean, do we need more players in those markets? I mean, New Zealand's 5 million people, 4 or 5 banks seems a reasonable number, maybe. But I mean, should we also perhaps be looking beyond banks, two open banking, two fintechs?
Absolutely. And it was pleasing to see the Commerce Commission had that conference up in Auckland, I think 2 to 3 weeks ago, where day one was all about the competitive landscape and day two was about open banking and how we move from A to B in regard to open banking. I guess the industry's perspective is that they want to take control of it, whereas the problem is they've got every economic incentive to slow the process down.
And I mean, from a perspective of a small business owner and a farmer, I mean, what do they ultimately need from a bank or another lender that perhaps in the future won't be a bank?
I go back to the fundamentals of banking. The fundamentals of banking is pricing for risk and taking risk, right? And what we're seeing out there at the moment is that SMEs and farmers are certainly being priced for risk. How much risk are banks actually taking? And this is what I'd be interested to see within this FEC inquiry. Let's have a look at return on equities out of the banks by segment, not the aggregate top-down number. Let's break it down into personal lending, including home lending. Let's have a look at business lending. Let's have a look at farm lending and the institutional book. And have a look at where those ROEs actually sit. And I think we're going to be surprised how high those ROEs are for certain segments.
You think in terms of return on equity, do you think they're earning more from their business and rural lending?
Without a doubt. Yeah. But they should be earning more within those books because they're higher risk. But the key here is to go through each segment and look at the risk-adjusted returns. Now, this is, we're talking a lot about competitive pressure across the banking landscape, and that's one influence on productivity growth. But there's a deeper issue here in regard to the balance between risk, pricing of risk versus actually taking it. And, bank profits are easing off as we speak. Bank margins, in my view, should be coming in as we speak because term deposit rates are moving up and we're seeing an awful lot of more money on term deposit. But we're seeing bank margins that are flattening out. Now, I think that's because business and farm margins have been expanded.
Okay. What about the government in all this? I mean, obviously the politicians are going to be, looking at this in the select committee inquiries, but I mean, ultimately, what is the role, in your view, for the government in helping improve competition in the banking sector?
Well, I guess if I go back and look at the big picture, it's pretty simple. New Zealand's productivity growth, the trend growth rate has been deteriorating for the past 20 years. And productivity growth is at the epicenter of living standards. So what's called multi-factor productivity growth is now averaged about 0.2% for the past decade, which is basically standing still. And we all know the problems with infrastructure, education, these sort of areas that we're starting to see a little bit of momentum build towards. But there's two areas that we need to look at. One is competition policy, and this is not just banks, this is supermarkets, this is building supplies, this is oil companies. And there's also that balance between pricing versus taking of risk. The whole process of credit intermediation is a pretty critical part of economic development. And I don't think we've got financial system settings right on a whole lot of areas, whether it be what the Reserve Bank has done in regard to getting banks to hold more capital. Well, there's a price that we're paying for that on the other side. And we need to ask the question, are we prepared to pay for that price? Banks have increasingly become very vanilla in regard to their approach. More and more lending going into the housing market. That's coming at the expense of the real productive part of New Zealand. Unfortunately, financial system settings or banking doesn't tend to be one of those sort of areas that if you think about what we need to do to sort of make New Zealand a better place economically in regard to taking risk and also driving productivity growth, we tend to look at a whole lot of areas and we sort of overlook what's a fundamentally essential one, and that's that flow, that process of credit intermediation is absolutely essential. Now, I see the Prime Minister's been talking a lot about encouraging the taking of risk. We have a bit of a punt. Well, in order for firms to take risk, you need the financial system to be prepared to take risk.
So, I mean, how do we get a financial system that is prepared to take risk?
Well, once again, I think we need to have a look at a whole lot of things. Look, number one, that debate with the Reserve Bank, what they've done in regard to getting banks to hold more capital, what's been the price that we've paid on the other side? Because I think there is very obviously a price that we've paid. Secondly, are banks maximising long-term profits and short-term profits? And I think their profit maximises in the short term, not the long term. There does not seem to be the same number of old grey-haired bankers around the banking system that we've been used to see. Bankers are now, they're not the solution providers that we used to see. So what's inhibiting that sort of stuff? What's the role of boards in this? What's the role of the investment community that drives firms towards short-term behaviour as opposed to long-term behaviour, because we'll focus on the 6-month profit cycle as opposed to the 6-year cycle in regard to where things are going. But the OECD within their report on New Zealand also talked about your poor management capability as an inhibitor of productivity growth. And this comes back to, we can't just point the finger at the banks and the regulator. We need to lift our game across the board, and you start to think about the role of financial literacy in schools. You start early. Maths, the PISA scores across New Zealand that have been going down for the past 10 years as opposed to going up. And there's a whole lot of things that we need to do if we've got a vision about driving productivity growth towards a better rate than what we're seeing at the moment, because 0.2% is just awful.
The previous government was looking at launching what they called a business growth fund with the government and the major banks as investors, as a way of helping get capital via equity investment capital into small businesses. And this followed the similar schemes that have been introduced, or funds in Australia, the UK and Canada. It obviously didn't get off the ground prior to the election and doesn't appear to be a priority for the new government either. Would this be something you think would be useful to have?
Subject to the design parameters. The devil tends to be in the detail of these sort of things. So if you look, if we go back and have a look at the financial assistance that the government tried to give to businesses through COVID, it wasn't just about the wage subsidy. It was access to loans, all this sort of stuff. And it turned out to be an absolute smozzle, because Treasury and the government didn't really understand how the banking sector worked. So that probably argues for staying out of it as opposed to stepping in. If you've got a system that's delivering the right sort of economic incentives, I'd be encouraged to trust the private sector to take care of the rest. The problem at the moment, I think there's too much short-termism, and I just don't think we've got those regulatory settings that are right. We just screwed the scrum too far to one side.
So in terms of this Select Committee inquiry, what would you like to see in the terms of reference from a business and farming perspective?
Top of the list is that the balance between the pricing of risk versus the taking of risk. And how is that impacting productivity? The word that's coming through time and time again is about competition within the banking sector. Now, a more competitive banking sector will deliver more productivity. But I think we need to have a really good, hard debate about where the money is actually going, the composition of bank lending, whether it's short-term behaviour versus a long-term growth maximising strategy. So let's have a serious conversation about risk going forward, because risk is a big enabler, and it's not open season on risk, but risk is an enabler of innovation, driving productivity, striving to do something a bit different. It just seems like we've screwed things far too far towards a low-risk approach. And ultimately, we pay the price for that over time.
Okay, so look, finally, Cameron, how realistic do you think it is if we get, these inquiries right and we make some encouraging changes along the lines of what you want to see? How realistic is it that we could see major change in the business and rural banking markets, and how quickly could it actually happen if we got things right?
Well, sunlight's a great form of disinfectant. Yeah, so I'd like to see information, on bank returns by segment. We know the Commerce Commission report has said, well, banks seem to be making abnormally strong profits relative to other countries around the globe, and their loan portfolio seems to be lower risk. So that doesn't seem to add up. But let's dig into the detail on that and look at it sector by sector in regard to what's going on. And I suspect that will provide some pretty interesting information in regard to what's going on.
Well, look, thanks so much, Cameron. There's obviously going to be a lot of water under the bridge on this. We'll look forward to seeing how it unfolds. That's Cameron Bagrie of Bagrie Economics. And I'm Gareth Vaughan from interest.co.nz with another episode of our Of Interest podcast.